So we're going to talk about what makes a startup an attractive investment. And we've heard it's the team, we've heard it's the market size. Hopefully you're going to tell us it's something completely different. That's what we're hoping for. But we're going to have a discussion about what makes something an attractive investment, what makes it interesting to entrepreneurs, investors, and things like that. Jens is going to introduce himself and tell us a little bit about his background.
Yep.
So if you would be so kind.
Sure. So I'm Jens, I'm a managing director at TechStars. For those of you who are not familiar with TechStars, we are one of the world's largest accelerators. I think we now have 14 or 15 offices globally, invest in about 150 to 200 companies every year, about $120,000 in each company. I'm one of the 15 managing directors making these investment decisions, so I make between 10 and 20 investments every year or so. Before this, so chronologically, at some point I was a student in Germany, I then moved to the UK. I built some technology there at the university, which we then licensed to a water company. I then joined a startup, which grew quite quickly to about 50 people or so, and I was promoted a number of times. Then I left, set up my own company, made an exceptional number of mistakes in doing that, still managed to raise quite a lot of capital for it. Company is still around today, hasn't exited. I then left that company at some point to join Forward Internet Group and set up a new division for them. Forward Internet Group is a company with around 500 staff in London, and initially it was an operating company. It became an investment company. There was a department that was doing buyouts of underperforming internet companies and doing turnarounds, which worked spectacularly well and made a huge ton of money. We had an early stage investment vehicle. And then I joined to set up a company builder function, so a startup studio function. And we had a very different approach there. We basically just invested in individual entrepreneurs. We had an internal team of about a dozen sort of developers, marketeers, designers, and so forth. And what we said to the entrepreneurs was basically, we don't really care about your ideas all that much. We just care about you as an individual because we think you have got the characteristics of an interesting founder, and we don't really care what kind of company you build us or with us. We just care it's a really interesting one. And we said we accept that the vast majority of things that we start with entrepreneurs will fail, so we'll just iterate through things very, very quickly and we'll pivot very, very rapidly. And we did that, and we produced quite a lot of companies, and then eventually I made a decision to move back to Germany, and then TechStars approached me and said, we've got some activity in Germany now. Can you please help us with that? And so that's what I'm doing right now.
Okay. So we've sort of heard a bit of a cross-section of, sometimes you tell them it's just the team, and as long as you have a magic team, we'll figure out a home for you. How many deals do you see on average?
What, per year?
Yeah, on a regular basis. When you're looking through, how many deals are you looking at?
I don't know. I mean, per year, I probably look at 3,000 potential investments.
And what do you focus on, and what gets into the save pile, which I'm assuming is pretty small?
Yeah. So the vast majority of startups don't get the foundations right. So there are things that are fundamentally flawed about the startup right from the start. Yeah.
So can you identify some of the foundations that you're talking about?
Yeah, sure. I mean, it's things like, there's no committed team. There's a lot of, maybe it's part-time individuals. The founders have not worked together before. They are geographically distributed across different cities. They outsource technology to somebody else. The team doesn't really have the skill set or the necessary experience or the necessary leaning towards the kind of idea that they're actually doing. Quite a lot of times the teams haven't really done any amount of meaningful homework. They don't really understand their customers. They don't really understand their competitors. They don't really understand the business model that they're driving. So there's very little of a foundation there that you can actually work with. And I would go as far as saying that about 80% of the teams 90% of the deals that I look at fail for really fundamental. I mean, we just, as I said, they don't make it to the safe pile largely for those kind of reasons.
And I guess what I'm hearing is that a majority is based on the fact that the team isn't mature enough or the team isn't experienced enough. and it's the team that's,
Or,
for the
or it's
most
not,
part,
or it's not constituted correctly,
Okay.
right? So you've got one person who's working, and then 3 others who are still in their jobs. And what am I actually investing in? What's the team? They haven't really worked together before. The probability that they're going to fall out with each other is huge. So why would I? There's so many other teams for me to invest in. They just don't go past sort of like the first point.
So what you're saying is the team is putting the lack of that foundation, which is primarily team-based, is what's putting them in the reject pile. But is the team enough to make them an interesting investment?
So no, but so if I have what I think is a very interesting team, then I'll definitely talk to them.
Okay.
Right.
And then what distinguishes that next level from the ones that get moved into a potential investment pile?
So, well, we come back to what's actually fundamentally what do I have to believe in, so that I can assume that this company will be very successful.
Okay.
And can I believe that? That's fundamental, because then you get into this area of where you're not looking for facts. You're making quite a lot of assumptions.
Okay.
So you're saying, okay, so I believe that there is actually a market for this product. I believe or I know that this market isn't overrun with dozens of other competitors. I know that this team has a significant edge somehow, and they will have a few years where they can, try to win ground and basically start to build up an initial company. And I think, they have a reasonable chance of building a business that's going to generate, tens of millions or hundreds of millions of dollars of annual revenue. But those are all belief questions, right? So that's what you then, when you talk with the teams, those are the things that you then debate.
Do you have a particular thing in mind, though, when you're talking to these teams that you want to know that can help you move forward?
Yeah, so the first question that I ask teams is always the same, and it's who are your customers? Because in my experience, you have this, if somebody can describe their customer and what they need really, really well, mm-hmm. Yeah, then the probability that they can actually build something that the customers want is relatively high. Whereas if somebody just, they have never talked to any customers, they don't know who they are, they don't know their telephone numbers, they don't know their email addresses, they haven't had personal face-to-face or at least telephone discussions with them. And I think the probability, then it's just down to luck, then you're rolling the dice. Yeah, and I can't really afford to. Rolling the dice is a highly unsuccessful way of making investments, so you don't want to do that. So if somebody really knows a lot about their customers and has done a lot of customer interviews, the probability is that that they will actually be able to build something meaningful.
And with the volume of transactions that you do on a regular basis, one would assume that you're not active. TechStars is an actively hands-on investor that we typically see with smaller angels who are engaged with the company, and so tell us where that differentiates.
Okay, so with any accelerator, whether it's TechStars or anybody else, we have a very intense 3-month period where we're super hands-on in a sense, and afterwards we just become more like a regular shareholder, I think is the right way of saying it. So we work with the company in the same way as a normal angel investor would.
And does that change how you select companies, knowing that you're going to have that more of a hands-off approach down the road?
No, I wouldn't invest. As an angel investor, I wouldn't invest in different companies than in the companies that I'm investing at TechStars. It doesn't make any difference.
Okay, so it's the same process.
It's the same kind of process, the same kind of thinking that goes behind it. Yeah.
And how important is market opportunity in part of that assessment?
Well, so there are some markets where, so I think it's a fallacy to say, or there's a huge opportunity, because if it's that obvious that there is a huge opportunity, then it's typically overrun by a whole bunch of people. And then you need an extraordinary amount of capital to try and position a company correctly. And for an early stage investor, that's actually terrifying. Yeah. So typically the really interesting companies do things where it looks like a meaningful market, but nobody really knows how big it's going to become. Or you can speculate that it might become large, but you don't know that. And that is effectively one of the biggest investment risks that you have. Yeah, but what you want, Peter Thiel has actually written this up beautifully in his book, right? So it's all about, you want to be able to conquer something that's meaningful, and then successively conquer and monopolize more and more of an ever-growing market, or more and more adjacent pockets of an ever-growing general market. And I think that's, with all of the companies that I've invested in that have actually gone somewhere, that's exactly what's happened. So I totally subscribe to that thesis.
In the companies that you've invested in that haven't succeeded, is there something that you can look back on and say, you know, we're going to do this different going forward? What have you learned from the companies that haven't succeeded, and your picks of those companies per se?
Well, I mean, it always comes down to the companies typically fail because either the team doesn't work, so that's the risk factor, yeah, or they get crushed by competition. They just and I mean, maybe not even directly, but there's just so much competition that it's very, very difficult to actually make any meaningful amount of money. So to give you an example of that, I once invested in a wine company. That was actually really stupid because wine is a highly competitive market, right? And you really don't want to be in a highly competitive market because your margins are so compressed in that market that you just can't get a foot on the ground. And even, so it takes a lot of capital. I mean, you probably have to invest $10 to $20 million just to get to a profitable company. And even when you're there, you're still not going to make a lot of profit because the margins are just so tiny in that business. So because there is so much competition, and even so you're never going to be like the world's largest wine company or something like that in this space, the market-dominating wine retailer. That's just not going to happen because there's so much local small players everywhere. It's very, very different. It's the same as if I said, if I tried to start a new company in this space, what I would have to do is I would actually have to buy up and roll up all of these different kind of suppliers, similar to what InBev did, yeah, right, in the beer space. So I think that's a meaningful, but that's a private equity model, right? That's not a venture model, and that requires a huge amount of capital.
What are some of the other? So you've learned that, you know, the competitive space is obviously something
Yeah.
you're not interested in going forward. What else have you learned, you know, in hindsight that, you know, you would take to new investments and avoid?
So it's what I said is that there are. So the competitive situation is problematic because you require a lot of capital to actually build these companies up, and the problem is then that you either are able to find this capital or you aren't. So one of the things that people underappreciate, for example, with Rocket Internet, is that one of the things that they were exceptionally good at was actually to go outside of Germany and attract huge amounts of capital. Because if they hadn't been able to do this, they wouldn't have been able to build Zalando. And that's the primary driver of returns in that business. Sure. Yeah? And because they were able to raise such a huge amount of money for that company has actually gone somewhere. Although the online shoe business is actually not all that great, right? And Zalando is, you know, I mean, any e-commerce business is fundamentally not a great business to a certain extent because the product margins are just, I mean, the overall margins that you have are just so small. Yeah. Now, the only thing that makes it interesting is that the market is so large. So if you can build a large company, it will be worth a lot. But that also requires boatloads of capital. So the key difference, so you have enormous capital risk in these kind of businesses. Yeah, and that's what I mean with competition. So as an early stage investor with almost no money, us, right? So if we go into those kind of businesses, we'll get diluted down to almost nothing. So it's highly questionable whether we will make any huge returns in those kind of investments.
So are you looking at companies that won't require large VC rounds going forward, or are you willing to accept the dilution knowing that you get a share of something big? What's your approach?
I think the way in which I look at it is to say, okay, I'm looking for companies that can grow quickly enough without requiring a lot of capital early on, so that I have a meaningful, so that when the next round comes, the valuation is already so large. I go through not 10 rounds of funding, but maybe only 3. So the dilution that I take and as these companies get built is smaller. Yeah.
And does the organization typically take a pro rata share going forward, or is just that initial investment?
So we make an initial investment. We have we can take our pro rata share if we want to, and the approach that we generally take is that sometimes we take it, but we never lead rounds, subsequent rounds, because the signaling risk issues are quite significant. Okay. So because let's just say if we did, you know, accelerate a class of 10 companies and afterwards we said, oh, by the way, we're investing $5 million into that company, right, yeah, then everybody would say, okay, well, that's a good company, all the other companies are probably a bit shit, yeah, so that we can't really engage in that kind of behavior. So what we would do is if somebody else, so the good companies will get financed by somebody else, and we will then, once the round is constituted, or is more than halfway funded, then at some stage, when the price has been set by somebody else, we can then say, okay, we're going to put in a little bit of money as well and maintain our pro rata.
And do you focus on certain industries or certain industries you don't like and that you won't touch?
So I personally don't really, there are a couple of industries that are so highly competitive that it's just really, really challenging, right? But I personally have a much more of a preference for certain types of business models. So, and I don't really mind the industry so much.
Can you share what that means by which
Sure.
kind of business models?
So business model, or I think of it as business model categories. So there are businesses where, for example, if you think about it, how can you earn money in the company? There are only three fundamental business models. You either charge a consumer directly, or you have some kind of advertising play in one way or the other, or you're charging businesses directly. There's very little else, really. So, and within that, you have probably about 5 or 6, 7 categories each that make sense, right? So on the B2B side, you've got SaaS businesses, you've got infrastructure as a service businesses, right? You maybe have payment solution businesses, or you have information services businesses, or maybe you are selling hardware with associated services or something like that, right? So, and depending on, so there are some of those categories that I personally, that is just where I feel very comfortable investing in them. So I like the vast majority of B2B categories. And on the B2C side, I personally tend to like booking apps or booking sites. So everything, or even personal services where there is no physical inventory involved. And it's just, somebody else deals with the fulfillment, or I'm buying a ticket to an event, then there's really no physical goods involved, and the margins tend to be much nicer.
So you left out the advertising model, one you're not a fan of, or?
No, it's just, sometimes I commit sins, but so we invested in a really nice company called Smile Mom in the last TechStars London program, which is doing really well and it's growing super fast, and that's a social network for mothers, right? That's definitely an advertising for, it's not quite clear how this is going to pan out and what the business model category exactly is going to be, but that has worked out as an investment, but for me that would be the kind of exception rather than the rule, because I don't come from that world. I haven't really worked in it for 10, 15 years. There are far more qualified people at TechStars to make those kind of investments than me.
And by the nature of the name, so we assume that you're looking at tech companies, and you're not doing pharma, or what happened? Will they come through the program, or could they come through the program?
Yeah, we just invested in a knitting company.
A knitting company, okay.
Yeah, but so I think
So let's take the knitting company as an example. This will be good. All right, we'll take the knitting company. What is it about the knitting company that made the folks say, this is an exciting investment?
So
I'm guessing you're not sure.
No, I remember the discussion, so I'm just trying to phrase it in such a way that I can say it here. But it was basically, so what they did is there are these, I know absolutely nothing about the knitting industry, right? But there are knitting machines, and it's a standardized process. So there's a couple of market-leading machines that get sold to somewhere in India or China, and these machines are used to make all the garments that people are wearing, right? Okay. And so what these guys did is they basically built software that connects these knitting machines with on-demand printing services, right? So you can basically say, hey, I want this design on my woolen pullover, and then it gets shot over to some machine that sits somewhere, and then that machine will basically make your jumper out of the, it's not printed, it's made out of the cloth in the colors in your design. Right? It's a highly personalized service that's completely scalable because there is no setup required. It just does it automatically, right? But the thing is, so what really convinced us to invest was when the founder was sitting there and he had the knitting machine actually in his office. And he showed us the knitting machine, and then just the joy of, he was so excited about the knitting machine and what he could do with a computer and a knitting machine, and that sheer enthusiasm, we just thought, oh, fuck it, we're going to fund that. So we don't know how big that's going to get, or we don't know what the business model implementation is. Is it a B2B company? Is it a B2C company? How is that going to pan out? We have no clue, but we think we haven't really seen anybody doing anything like that apart from those guys. And we just really like the concept, and we like the founders.
So, anyone who has the fortunate job of reviewing lots of business plans gets the opportunity to see a boatload of buzz phrases. Are there any buzz phrases that just shut you down? Is there any, buzzwords that you're like, oh, that's just so overused,
Yeah, all of them. I think sort of sharing economy is one of them, most certainly. Oh, we're a sharing economy business. Yeah, great. What does that mean?
Right. So that doesn't necessarily excite you when they tell you they're sharing a company.
No, because I don't really think along, I don't think in concepts of, oh, fintech is hot, oh, edtech is hot, oh, sharing economy is hot, or something like that. That doesn't really work for me. Because I think as soon as these things become hot, you're past the point where you really want to invest in the vast majority of those kind of things to a certain extent.
Right.
So with WhatsApp, people wouldn't have said it's a social network, right? So, I mean, not in the way in which we think about social networks. It's a different kind of thing. So I think the problem that I have with those kind of buzzwords is I try to discipline myself to try and think up from first principles as opposed to invest in trends, because I don't understand how that translates to good returns.
And how do people, just submit plans, and so they're cold calling into your system, because obviously you must get a tremendous amount of plans. Is that a huge component, or do you guys rely on, your partners and your introductions as a warmer source of deal flow? Where your deals come from?
So we get a huge amount of applications for every program. I mean, it varies. Can be from anywhere from 500 to 2,500. It depends on a lot of time of the year and how many other competing programs there are.
So the warm introductions under your business model don't make a big difference, or
no. So what we try to say is, so let's just say when we're running a program, we try to identify 10 companies that we might want to invest into by ourselves, and then another 10 of similar quality will come via the application process, and then we'll figure out which ones we'll invest in later on. So we have a blended approach of hunting for our own deals, and then the application process flushes in a huge number of companies that we've never heard of.
Plus, your brand obviously helps generate leads for you, I would assume.
It's the same for every investment company.
Okay.
Yeah. Because if you think about it, there are really no, the brand is the number one differentiating factor in the investment business. Because it's very difficult for a VC to actually deliver 10 times better service than the next VC, or to have such enormous network effects somewhere that it starts to make a huge difference. And actually, I think this is one of the more interesting points for the larger accelerators, because they've invested in so many companies that they start to have such a huge network of alumni, mentors, investors, and being able to reach into that is actually starting to drive quite significant parts of the new applications and thus returns. Yeah, and I think that's probably one of the very first times in the venture business that you now have maybe a handful of accelerators in the world who have that leverage, and if you're a sole accelerator somewhere else, you don't, and that's starting to make a huge difference.
And what are some of the lessons that you've learned through the different programs that you've been involved in, that if someone were a new angel, that you would give them for advice and share with them, that they should be looking for when selecting new companies for their portfolios?
So if you have never invested before as an angel?
Never invested before.
I think you need to accept that probably the first 10 deals that you do will be a bit shit, not because these people are not intelligent, but because it is you need to start thinking in a certain way about things in which you actually haven't thought about it before. And that's the first thing. Or certainly, maybe I just explain how it was for me. That's just easier. So for me, I didn't really understand how to think about many of the things that we just talked about. Number one. Number two, I didn't really understand my own style and the kind of things that work for me, because there are people who are very good at investing in things and picking the right companies in the right segments that works for them, which would never work for me. I couldn't identify them. It's not my flavor. Mm-hmm. Yeah. So I think it took me about 10 deals to figure out what my flavor is of the kind of things that work for me, where I have a good way of figuring this out. Yeah. And I think you need to not spend all of your cash in the first few deals until you have figured out what you're actually good at. And then, as you start to invest in deals where you suddenly start to see these companies taking off to a certain extent, then you should start investing far more capital. So let's just say if you had $1 million and you wanted to invest it, I would hugely encourage you not to make $10,000, $100,000 deals, but maybe you start with $10,000, $25,000 deals or something like that. You figure out what you should be doing, and then you spend the next 500,000 on $10,000, $50,000 deals or something like that.
And part of your recommendation process, do you sort of need to get the buy-in from other folks within the organization as to, or can you say this is the company I want in the program?
So the managing directors have to live with these companies for 3 months, and obviously it's because every location has got its own little fund, and the managing director has got the relationship with the people who have invested in the fund. It's pretty important that the managing director is extremely comfortable with the companies that are in the program, right? Okay. But the way in which it practically works is that, no managing director makes a sole decision by themselves. It's that we in a sense constitute a recommendation or an investment committee that's made up of different individuals. So that will include other managing directors from other programs, and it will include investors or LPs in the funds.
And does, having to justify it to someone else, does that change sort of how you look at the deal, or how or how you decide that it passes the benchmark? Because you have to convince somebody else also that beyond that you like it, you have to convince them why it's a likable deal, right?
I think it's, so what typically tends to happen is that, so it goes a little bit like this, that we have at the end maybe 30, 40 companies that we could arguably invest in, yeah, and then we have to pick 10 from those. And there's a very intense debate. The more points, if you have different points of view from different people who have talked to the company, have done some research, it just helps you speed up your thinking process about that company, yeah? And it's not really a thing that we say, okay, we're not quite sure, we're going to have a vote, and it's either this one or that one or something like that. That doesn't really happen like that. So it's just more of a, I don't want to call it a consensus finding approach, but it's more of a, the managing director takes input from quite a lot of different people, and then that drives their own, the decision-making process. And then they say, well, I'm very tempted to take, or I prefer this company over that company. Tell me why I shouldn't do that, or tell me why I should rather do that. Yeah.
And I guess the reason why I asked that is that many individual angels don't have that resource to bounce off. They're making the decisions by themselves. So should they be looking to more of a syndication where they can get some outside input?
Yes. I would strongly. I mean, if you think about it, you would want to co-invest with the best angels that there are. So then the question is, why should they let you into the deal? Right? So, and the best way, the number one thing that you shouldn't be is annoying. Yeah? There's actually surprising how many annoying angels there are, or how many annoying investors there are who change their mind at the last minute, who suddenly, everything is signature ready, they just they want to renegotiate something, or they want to take a larger stake or a smaller stake, or, then they make some other fuss somewhere. And it's just, if you become known as an individual who acts like that throughout that kind of investment process, then the good investors won't let you into the syndicates in the future, and then you don't get into the best deals, and then you have adverse selection that you've created yourself.
So one more question before we open up to the floor. Flip the question. So a startup comes to you and is looking for advice on how to raise money.
Yeah.
What would you tell
them? I typically, so it depends on what they're looking for, right? But let's just say if I'm a startup and I'm trying to, and let's just say I've gone through TechStars and I've raised my pre-seed $100,000, $120,000 or something like that, or maybe it's from somebody else, and then now I'm looking to raise an angel or a seed round, $1 million, something like that. Yeah. I typically advise people to not talk to venture capital firms. Okay, I think it's the number one time suck that it's like a black hole that will swallow you up. Right? So what I typically tell people is try to raise an angel round first. Because once you've got an angel round, and once it becomes really large, the VCs will take note, and suddenly they'll want to deal with you. And then if you want to then raise either a large seed round with VC participation, or maybe you actually do like a small Series A round or something like that instead, you will close it faster than if you try to actually go the VC route initially. Because you've got all the social proof from all the angels. Yeah? In an early stage company, you've got very little proof as it is, let alone social proof. But if you have a whole bunch of high quality angels, that really helps. That's the first advice. The second advice is aim low, or talk low. So if you want to raise $1 million, say you want to raise maybe $500,000. Yeah.
Okay.
And then, because let's just say, God forbid, you only managed to raise $800,000. If your target was $1 million, then you would already be a failure. Yeah. So what you want to say is, no, I'm raising 500,000. Ooh, I'm oversubscribed, 50% above my target. And everybody thinks this company is hot. Yeah.
With that, I think we're going to open it up to the floor and let them ask you a couple of questions as well. So
Sure.
Please. Any questions from the floor?
We are here in Central Europe. How many startups from the region do you get in your program?
So in the cohort that I co-managed in London, we invested in one company from Estonia.
That's all.
Yeah, I mean, so let me answer in a different way. So that's a London-based program. We had 3 companies from the UK, 2 from the US, 1 from Ireland, 1 from Germany, 1 from Spain, 1 from Israel, 1 from South Korea, and 1 from Estonia. So that was the spread. But in previous programs, I know John had invested in a company from the Czech Republic, another company from Estonia. Can't really remember what all the companies. He's actually invested in a company from Bulgaria that I remember. So he's invested in companies from all over Eastern Europe. But it's not as if there are 5 companies that come from Eastern Europe in one London program. Even intuitively, that doesn't sound right.
Okay.
You mentioned that the people are really important, the ones that start up a company. What if the company fails, but you still look at the people like having great potential? What do you do with that afterwards in your program with the people?
What do we do afterwards? Okay, so you mean a company fails during the program? So they just figure out that their product doesn't work or something like that?
Yes, during the program,
oh, yeah,
you find out.
we say, so one of the things that I tell all the startups is, if you don't get so much traction that you're overwhelmed, and when you launch your product and you're not overwhelmed by demand in one way or the other, then there's probably something that's fundamentally not right with your business. Because there are businesses where that happens, and you want to be a business like that. So I would encourage them to change something about, if not everything, about their business very drastically, very quickly. Yeah. So we've had, of the 11 companies in the last program, 7 pivoted partially their business in one very significant element. And those are the 7 businesses that pivoted are the ones that are doing better than the other 4. Right? So that's basically that. You try to, doesn't work, change something significantly, quickly. That's the advice. And if you do this quickly enough, you can come up with a completely different business idea within a few weeks by talking to customers. You can start executing on that, and that's what we would typically advise.
And I think maybe what you were alluding to a little bit is have you recognized a talented team and then sort of taken them as an entrepreneur in residence and wait for, the opportunity to give them, a product that they could then run with?
So at TechStars, we don't really do that kind of thing, but
okay.
at Forward Labs, that's all I did. Because we just took in individual entrepreneurs, and it was the same thing. So we said, okay, let's try this product. Let's see whether the market really behaves in the way in which we think it should, or let's see whether our hypotheses are correct. And if they weren't, then you have 2 reasons why that might be. Either the entrepreneur was not very good at executing, building a startup.
In general, right?
In general, right? In which case we would disengage, or we're just wrong. It just didn't work. So we then said, okay, next one. Yep. Next one. And then we tried to find the thing that worked. And sometimes the entrepreneur just couldn't find. I had one case of a really great executor who just couldn't find the thing that he was passionate about. Yeah. So then we stopped working together as well. But we've had several examples of people who actually started with one thing and then they changed it, and then eventually found something that worked. Yeah.
Other questions in the audience?
Hey, I am Mitko. I want to understand what is early stage ideas? How can put the idea in early stage ideas and another stage ideas? What is the meaning of this word? Early stage ideas.
I think what's the earliest you'll look at a deal and based on solely concept versus any sort of execution?
So if you think about it, as an investor, you need to have proof of execution capability in the team, because otherwise, what are you investing in? So, and if you think about it, it's like when you're hiring people, apart from checking can these people actually do their job, you look for two things. You look for motivation, and you look for accomplishments in the past. Because people who tend to be highly motivated and accomplish things in one job and are motivated for the next job, the probability that they will accomplish something is very high. And it's actually quite similar to startup investing. So to give you an example, make it concrete, we invested in a company called Shortcut, which was less than a month old when they applied. And the two guys who ran it, Richard was the guy who set up Uber in the UK and who was a managing director there, and Buff was the third or fourth engineer at Eventbrite, and he had grown with the whole company and had several managerial positions there. So these guys could definitely execute, right? And they had met each other at a previous startup which failed, where they weren't one of the founders, and then they left and built a company together, right? And they had actually talked to a few dozen customers and had sold to one of them their product before they had a product. And that's the point at which we invested. So that's as early stage as it's ever going to get. And we're happy to make those kind of investments, but that only works when you have that kind of, that ability to evaluate that those guys can execute somehow. Because if you can't, then you're just investing in a dream, and that's nobody should really do that in that kind of way.
One of our earlier speakers sort of suggested that, you don't want to invest in the second company, especially, where they don't have the same edge and they don't have the same drive that they had, the first time around. What's your thoughts about that?
You mean, when
serial entrepreneur has done really well, he's coming back to the market, he has money, so he's not as driven.
So, no, I think there are different types of sort of serial entrepreneurs, right? So they're the ones that have built a company, sold it for $10 million. So they've got a few million in the bank, and then they think, right, but this time I really want to go for it, right? I want to build something that's monster huge because I feel I've got it in me. I think that's great,
yep.
Right? Now, then if I have the guy who's already built a company and sold it for 200 million, yeah, then they probably wouldn't come to me.
Yeah? You need to wonder why they are, right?
Right, I mean, they would possibly only come to me if they moved country and they wanted to reconstitute their network or something like that. That would be the only justification. Otherwise, I think it would be very difficult to, that I've never really seen that happen at an accelerator.
Okay.
I mean, when people have had really massive exits, you've got so much of your own capital, you've got the networks, you know how to build a company. It's very rare that we would see anybody like that come in in an entrepreneurial capacity. Yeah.
Any other questions? Go ahead.
Do you looking for demo or prototype in early stage ideas?
Can you repeat that?
Do you looking for demo or prototype of the project on early stage ideas project?
So I think the question is whether we help.
Is there a prototype? Do you require a prototype or something along those lines?
No, it just goes back to what I said. So if you have a very inexperienced team that has never done anything before, then there has to be more of a product, right? If you have people who have already proven themselves somewhere, then you need less of a product because you know that those people can build product, right? So then you're not, that as a risk factor, you can remove that at least partially from the equation. So we don't require I personally don't require a product to invest into a company, but then the team better be, like significantly experienced in one way or the other.
Okay. I think we have time for one more. Is there any other questions out there?
I have many questions.
Sure, one more.
English is better. Do you have some template to check and verify good ideas and good teams?
Whether we have a template for checking ideas.
So a checklist or anything?
So because we get, let's just say 1,000 applications per program, there is actually, it's all in a database, yeah? And we ask, I think it's 50 questions or so right now, maybe it's a little less going forward. And we then we evaluate those companies. We look for certain things, right? And then every managing director has got their own way of looking at companies, and it goes back to this, do I primarily look for the team, and then I filter out the good teams, and then I look at the markets that I like, or do I primarily look for good ideas, and then I filter out the flawed teams? later on. It doesn't really matter because it's like a Venn diagram activity, right? You basically are drawing circles, and some people start with one circle and others start with another, and but eventually you end up with a very similar result, actually. Yeah. So yes, we do have. I mean, I have got checklists. I make sure that there are about 20 questions that I ask people, and I make sure that I have asked them.
Okay, and last question: do your organization invest in big projects?
Big projects.
Long, not long, but very big, something like game-changing product. Do you
Yes, I
believe
mean,
in
yes, we've invested in companies that are now worth quite a lot and have grown to quite substantial size. We invest in some things that are, I mean.
I think he's going to clarify the question for you.
Okay.
Actually connected with that, you would need a follow-on funding. I mean, are you planning to set up like a follow-on fund? Like Seedcamp, they've recently launched their own fund.
Yes.
Which is in addition to their incubator.
So is TechStars going to?
We've got two different types of follow-on funds.
So you can follow on a big idea with follow-on rounds.
Yes.
I think that's basically.
We manage about $300 million of capital, I think.
Okay.
So yes.
All right. We're going to thank Jens for his time and his participation. Thank you very much. Great. Thanks.
Thank you.